Okay, we're now going to complete our derivation of the model of economic fluctuations. You'll recall that this model is represented graphically in a diagram with the inflation rate on the vertical axis and real GDP on the horizontal axis. There's two lines in the diagram, aggregate demand and inflation adjustment, AD and IA. We've derived the aggregate demand curve already, and now we want to focus on the inflation adjustment curve, IA. The inflation adjustment line has to do with the relationship between inflation and GDP over time. What economists have observed by looking at the macroeconomy is that prices and wages tend to adjust slowly in many markets. Wages don't change instantaneously. People may have their wage changed once a year. Sometimes prices last for a long time. They don't change immediately. So there's kind of this rigidity, temporary rigidity to be sure, or stickiness of wages and prices. So what that means is that inflation does not usually change immediately when there's a recession or a boom. It doesn't change immediately. It takes some time to move. And it also means, though, that over time prices and wages start to adjust. So that means inflation does change over time, over years, over quarters, months, whatever it happens to be. And therefore, when we observe the changes in the economy, we'll see, for example, that when real GDP is above potential GDP, that's kind of like in a boom time, that inflation tends to rise. And when real GDP is below potential GDP, inflation tends to fall. So those are the kind of things we observe in the data. They have some rationale from the point of view of firms' behavior. They don't want to instantly change the wages of the workers if there's a recession or a boom. It takes some time to make those adjustments. Not always the case. Sometimes it moves more quickly, but just as a general rule, that was what happens. So given those words, we now sort of have a mechanism, a graphical mechanism to reflect that, and that's this inflation adjustment line. So as indicated in blue here, the phenomenon that inflation does not usually change immediately, we're going to represent graphically, as it's stated in blue here, is the IA line is flat. It doesn't have any slope, as you'll see, when the vertical axis is inflation. And then in addition, we're going to represent the fact that inflation does change over time by moving up and down this IA curve. So IA line will rise when real GDP is above potential GDP, and it will fall, as stated in the blue letters here, when real GDP is below potential GDP. So that's the idea. That's what's going on with this inflation adjustment line. So let's just draw it and think about it for a minute. So the axes, what we are focusing on now, real GDP on the horizontal axis, inflation on the vertical axis. We're now emphasizing that that horizontal axis is measuring real GDP compared to the normal potential GDP represented by the vertical line. When GDP is to the right of that vertical line, that's a boom period, where real GDP is, as is stated here, above potential GDP, and to the left, real GDP is below potential GDP, and that's a slump or the recession. Now what we're arguing is that in the short run, the very short run, the inflation adjustment line is flat. It doesn't move up basically with real GDP. It's just the same number here, regardless of what GDP is relative to potential GDP. It's a flat line. Prices are sticky. Inflation doesn't move very much. However, over time, the curve will move up if real GDP is above potential GDP, as shown in this diagram. The arrow is moving up, showing that that curve is going to tend to move up over time, not instantly, but over some quarters or years, because real GDP is above potential GDP. And over on the left here, if real GDP is below potential GDP, there's going to be some downward pressures on inflation, and that inflation adjustment line is going to start to move down over time. So we have these ups and downs depending on the state of the economy. Not a lot of movement right away, but eventually over time, and that's the dynamics, the dynamic adjustment that occurs over time that you're going to see predicted by this model and reflected in the data. So let's take a look at the data just to convince ourselves, is there any empirical evidence? Well, the fact is inflation tends to fall during and immediately after recessions, and that's when real GDP is below potential GDP. You can see this in the diagram, which is a picture of the inflation rate in the United States, going back to the 50s, late 40s and 50s. Each of the vertical shaded lines are periods of recession. That's when the economy is going down, real GDP is declining. And as you can see, in virtually all of these, in a recession, you'll see the inflation rate declining. And it continues to decline in some cases after the recession when the economy remains below potential GDP. So you can see the decline, clearly the decline in the most recent recession over here, inflation's declined. In the recession in 2001, you see inflation declining. You see it declining there, you see it declining. So to virtually every one, there's that decline in the inflation rate associated with the recessions. And you also tend to see inflation rising. That's not always as obvious, but inflation tends to rise in these periods which could be called booms before the recessions. In these periods, you see these increases. And that's, again, consistent with this idea that the price adjustment line is moving up, the inflation adjustment line is moving up when the economy is in a boom period, and it's moving down when it's in a recession or in a slump. Pretty clear in these data. Finally, let's look at the relationship between inflation and real GDP during the recession that occurred in 2001. The dots are really what happened. The little circles, I should say, are what happened. They're the observations. They're the data for the different quarters of the year during this period of time. And the dashed line is drawn at the 0 point. That is where real GDP is equal to potential GDP. The so-called GDP gap, the percentage deviation of real GDP from potential GDP, is 0. So to the right of that, real GDP is above potential GDP, and to the left of that, real GDP is below. And notice in the diagram that when you're on the right, inflation tends to be rising. So it's rising all through this period. Maybe there's a little exception, but you're on the way to a recession. And on the left, it's declining. So it's declining in this period, increasing in that area, declining here, increasing there. And that's just what the inflation adjustment line is trying to describe. And so our hope with the combination of the aggregate demand curve and the inflation adjustment curve is to be able to explain these observations. The diagram in the end, which you could call the Adia model, reflects both the aggregate demand and inflation adjustment. And so in this picture, if you first focus on the graph in the middle, we've now combined, as has been our objective, the aggregate demand curve and the inflation adjustment curve. It's telling us that the economy must be at the intersection of those two curves because we've derived them based on what the Fed does, based on what businesses do, based on what consumers do, based on the adding up constraint that spending must equal income. All those things have told us that we're on the aggregate demand curve. And we now looked at how prices adjust. That's the inflation adjustment curve. So we've got to have both of these relationships being satisfied, and they're satisfied at the intersection of the two curves as shown in the middle. And so we have at least the hope of getting the observations explained by this model. The intersection there is one of the observations that we want to explain, say in this recession of 2001 or in other recessions and other periods. And to kind of give a hint of what's going to come forward in the next few lessons, if you look over on the left, that's an example where the intersection of the two curves is at a point where real GDP is below potential GDP. So that would be kind of a recession period. It's drawn here just with the inflation adjustment curve happening to be higher. We don't know why it's higher. It's just an example, but it gives you a different intersection. So it has the potential to be able to explain the movements in inflation and real GDP in the cycle, business cycle that we've been looking at. And then finally over on the right, you have just another example where we've drawn in a different inflation adjustment curve. This one happens to intersect the aggregate demand curve at a point where real GDP is above potential GDP. And so that's a different answer, a different observation that the model is predicting. And so there's a lot of possibilities here. We also want to be able to shift the aggregate demand curve, not just the inflation adjustment curve. And when we do these, we're going to try to describe all the points in the diagram. There's kind of an equilibrium concept here at the intersection of these two curves. And in addition, if you think about the long-run growth of the economy and the fact that real GDP eventually returns to potential GDP, the diagram in the middle, where real GDP is equal to potential GDP, is kind of like a path where you're moving along potential GDP. It's kind of another concept of long-run equilibrium. So we're going to be using this model to describe what happens in the ups and downs in the business cycle, to analyze what happens with different types of policy interventions, and try to answer those questions about what the role of government is with respect to recessions and recoveries in the economy. So it's interesting to note that the graphical representation of the ADIA model has some interesting analogies with the supply and demand model, whether it's for bicycles or peanuts. So just summarize these connections in these two columns. So the economic fluctuations model, it has an aggregate demand curve. We derived that. It's downward sloping. It has an inflation adjustment curve. It's not really upward sloping. It's flat. It's easier to analyze because it's flat. It could be upward sloping, but it's flat. We have the concept of an equilibrium, or the intersection of those two curves. And the diagram, of course, the axes are with inflation on the vertical axis and real GDP on the horizontal axis. And think how similar that is to the regular supply and demand model, where we have a downward sloping demand curve. We derive that looking at people maximizing utility. We have the supply curve looking at firms maximizing profits. We argued that there was an equilibrium in the bicycle or peanut market or whatever at the intersection of those two curves. And the diagram had price on the vertical axis and the quantity of, say, peanuts on the horizontal axis. And in both cases, we consider moving the curves around, shifting the curves, and we considered movements along the curves and stressed how important they were. So a lot of the style of reasoning, the use of a graph to represent a model, which is so useful in the supply and demand model for individual commodities, is going to be equally useful in this model of the overall economy, the ADIA model. Keeping this analogy straight and reminding yourself of this will help you work through the macroeconomic model, this short-run macroeconomic model of economic fluctuations. Thank you.